Okay, the week started off very similar to how it ended last week. We gapped to the downside on the news and filled in. In fact, the difference today is we filled in all the gap, closed at the high of the day compared to Friday. So a nice, good, strong run. It kind of shows how strong this market is when this type of event, which generally would create a nice bout of volatility, is hardly a blip. So we're going to break that down. We're going to break down how mature this trend is, what signs we're going to be watching for any kind of reversal, short term, intermediate term, and then what we can do while it continues to run in the direction of this mature trend. So we're going to break that down with an idea from a sector for our trade idea of the day, from a sector that led this push higher on this current intermediate run that now is starting to slow down a little bit, and we'll talk about how to trade it. So let's go ahead and get started. Today is Monday, January the 6th, 2020. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see the nice rally we had during the day, even with the open lower. Nice good finish to the day. The near-term line dropped, but spent most of the day actually below 50 before this late rally kind of pushed it back up above 50. Pushed the momentum line up too, so that's not surprising. But nice, good. So we have the potential of a bearish near-term high point here. If we were to kind of break below these lows, we would probably get the near-term line below 50, and that would be a bearish high. That would be a somewhat lower high, relatively lower. I guess it's a smidgen higher. It actually would be a divergence, right? That divergence there with this low point being these lows here being kind of the target for that divergence that we've hit now on the open. So if we were to break through there, we'd probably have a little bit more of a decline. As of right now, we're not bouncing per se, but we're also not dropping either, and to more of this intermediate decline. Now keep in mind the divergences in the clusters when we're more than 2 months in, as I mentioned before, are signs of weakness. So, I'm not looking for a big, huge move to come out of this point that we're at right now, regardless of what's going on geopolitically. It's just from a technical perspective, we've got a mature trend, we've got a mature run. Even though the long-term trend is just barely getting going, the intermediate trend that we've been on for a while, for a few months. So in fact, we're now approaching closer to 3 months as we get towards the end of this week. So again, that doesn't mean necessarily that we have to pull off all of our bullish trades. That's hardly been the case of what we've done in our Market Outlook live videos, trades that we do. When we do the trades here and then we manage them in the Market Outlook live. We've already done today's trade idea that I'm going to show you later in the video in today's Market Outlook live session. Remember, it's one of our products for our Plus subscribers and our Premium subscribers. And so if you want to get that idea before the market closes and see what we're doing with all the other ones that we've done in prior Market Outlook videos in terms of managing them, then you want to get that product, that live video, which, like I said, is available for all of our subscribers, our monthly Plus subscribers, as well as our Premium subscribers. So, but the intermediate line, you notice, still above 80. The market sentiment line still above 80. So, like any weakness we're getting or any weakness we may get we're not going to fall off a cliff from up here. I know there's a lot of people worried about that, and that's why we grind higher. That's why things go slower. But the reality is we're not going to fall off a cliff up here, not without more of a convergence, as I'll show here in a second. And if we're not going to fall off a cliff, then what's our biggest worry? Well, our biggest worry is that we grind and we start to pull back and we build up too much risk here, when we should have built up more risk over here when we were just starting. And you would have seen that in our classes, especially my directional option strategies class. We put a lot more risk from a bullish standpoint here. You've noticed, and in some in my Market Outlook trades too, even with today's trade, I've been dialing back the risk. Still bullish, but not nearly as bullish as I was back here. And we've been able to get some good gains as a result of that over the course of this intermediate run. And now I'm slowing it down a little bit. And that's what you do from an active trading standpoint. I haven't done anything in the passive portfolio in regards to what this intermediate run's doing. I could care less. I'm more interested in the long term and being more passive. And as I mentioned before, I feel like we're still closer to the beginning of a long-term move than we are the end. So this market sentiment low point which this past year got us down close to 50 on the S&P 500 right here. Well, it did get below 50 on the Russell 2000. So it was more of a pullback. That October low point was more of a long-term low than what we think in terms of the beginning of a new run. You can see the market sentiment see a pull back, and we were sideways for all this year, and now we're starting this little breakout. And a nice little engulfing pattern at the moving average to the near-term line, still flat below the chart's midpoint there. So again, we might get a near-term bounce. I wouldn't expect a 7 to 12 day near-term bounce out of any bounce here. I wouldn't expect it to go up very much. Just you'd expect it to grind, and that's why you need to stay bullish, despite the fact that you might dial back the risk. You still need to trade the trend, and the trend is clearly bullish here, even with the short-term signs of weakness that are cropping up. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen. Hit that red subscribe button that pops out. There's also one down below the video. Also, while you're down there, click the thumbs up icon. That tells us two things: that you liked our video and that you want us to do it again tomorrow. So it's our survey that we look at to see whether you like our videos or not. If you do, click that thumbs up. If you don't have to click anything. Also, while you're down there, comment. What did you get out of the video? We always like to see what did you learn? What did you get out of it? What's the value so we can make sure we concentrate in those areas. You can subscribe to our website at marketscholars.com. There's a link popping out right there in the top right corner of your screen. Click on that link. It opens up. It takes you to our free subscription page. You can see some details on what you get there. You can subscribe, like I said, for free. You can also see details of our plus and our premium subscription plans there too, our monthly plus as well as our premium subscription plans and what you get with those. Join me or follow me on Twitter for more content in between these videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching our video on our blog, you can see there's the link to our Market Outlook live videos, today's, as well as all the archives. You can watch all the old. They're only 15 minutes long. You also have access to our classes. This is our upcoming, our next 3 upcoming. If you click on this link, view more, or even up here at the trading rooms, it takes you to our calendar. You see, you get what, 5? There's 8 different trading rooms and 2 Q&A sessions. Our plus subscribers, our monthly plus subscribers, they get access to all of these classes here, except for the Q&A sessions. Those are for our premium subscribers. You also get access to our live videos. So again, check that out. There's a link right there that takes you to some more details too. We also invite you to engage with us on social media. Here's our Market Outlook tweet. Click this heart. Opens up this new window, and hit like right there. Same thing, hit this thumbs up, takes you to your Facebook page. You can click like there as well. Again, the more you engage with us, the more they will promote our content to the top of your timeline, so you don't have to look at it every day or all day to see our stuff. They'll make sure you see all of our stuff. They do that with the accounts that you engage with the most, so we try to make that really easy for you here. All right, now let's take a look back at the charts here at the long term, and you can see how small that candle is. We talked about that in Friday's video. We've already got a little lower shadow there. Depending upon how much lower we get, we've got an upper shadow, so and the open's not going to change. So if we come back down throughout the week, we end up forming a transition candle like this one, or like this here, or like this over here, then that's what leads to the intermediate pullback. So we'll see if this week ends up being like one. It doesn't always. You can see here's one where we got a transition candle, did not lead. We turned back bullish again. So we got very strong momentum with the PPO as high as it is. So that kind of suggests that, once you get to these high levels and you start getting transition candles, you start thinking, okay, when are we going to start flirting with that gap, right? When you get such a big gap, it typically gets filled. You can see, if I were to look at all the peaks here, when you got these big gaps, the gap between the 50 and 200-day moving averages, when they get this big, here we had a nice long trend, and I actually think we'll get more like this. But at the very least, you flirt with crossing below the 50-day moving average, and we're still actually quite a bit above the 50-day moving average here. So I think any 23% type retracement in the intermediate line or intermediate pullback might get us below the below that 50-day moving average, and that's it. If we pull back down towards 3,100, obviously now you're starting to worry more about filling in all the way in there. So that'd be more of a 38% type retracement, which would not be a bad thing. As you can see, a lot of times it just leads to a new bounce where you can add more risk. Whereas when you get these types of moves, you don't know how long they're going to last. It took some, the election and tax reform and, quite a few things to kind of continue to move such a, this was a historically strong bullish trend in 2017. Let's take a look at the 3 green arrow charts for the S&P 500. Let's go to SPX first. Let's give you some perspective on this. So again, we're still red. We're getting the buyers are still in control. We're getting lots of candles. That happens. You get lots of red and green candles because after you get the surge in momentum, you don't really get very many more surges. You get a surge in momentum, then you get the pullback. Surge in momentum, pullback. So here's our surge in momentum, which is the smallest surge that we've had this past 52 weeks. And now we're not getting the surges anymore. We're grinding. So the buyers are still in control though, so we're not falling off a cliff anytime soon. And you can see, as I mentioned before, the 8 and 17-day moving average. We're still we got the 8 and 17-day moving average is still easily above their 30, and we came down and flirted with the 17 at the open today, but bounced off of that, and we're back above our rising 8-day. The MACD is high, but again we can with the buyer still in control, we can still grind our way down and let these lines converge, and that will be when you start looking for more of the intermediate type pullback. So that could take a couple of weeks. It could take a week or two. So that's why I'm not too worried about this transition this week being a transition candle that it turns into an immediate reversal, intermediate reversal. Now let's look at the intraday chart. And we'll come over here and we'll look at the intraday chart. And here you can see how we filled in the gap. We filled in a few gaps, right? We filled in this breakout to the upside here yesterday. We filled in this. We continued to fill in this gap that we had from, what was this, on Friday, and then this morning's gap. So pretty bullish. We're still above the point of control for the 4 weeks. So we're still in the upper half of the value area. It's a good sign. We've got a good volume node below us. So again, don't think we're falling off a cliff here. If any weakness we get, it's more going to be weakness that will keep us from good, strong moves higher. More likely just keep us grinding slowly higher. And you can see all the volume we have in the upper half and very little volume in the lower half. And this is moving up. We're only now 14 points on this range, and that's going to move up here really, really quickly for the next couple of days. We'll be at 312. Move up slightly more there, and then we'll start moving up that 4-week low really quickly. So if we can't continue to push higher here to new highs while we're starting to free up some room, then if that range tightens up, then you start looking for, if we have the high and the low tags over here on this side, that's usually a sign of the beginnings of that pullback, of that intermediate pullback that we've been talking about. So we'll kind of keep our eyes, and I'm actually going to watch for these high tags to move up as these low tags, but not nearly to the extent as the low tag is moving up. So I expect them both to continue higher, just the highs to get gradually higher while the lows really move up pretty sharply here in the next week and a half, 2 weeks. By a couple of weeks here, week and a half, the low point, the 4-week low point is going to be right, unless we break down to a new 4-week low, below this 319, it's going to be up at 319, and that's pretty high up there, barring how much higher we move the high tag. If you look at today's volume and trading range, the volume coming in just below average. The trading range was just above average at 3.37 points. But remember, 3.37, that's just a little bit above 1%. So the ATR, which is an average range, so it's not just today's range, but an average, it's still easily below 1%. So while you're still in control there, a move of 3.37 is not going to bring the ATR up above 3 points. So it is moving up slowly, and volume is still, volume is gradually moving higher. But keep in mind too that the 52-week high for volume is eventually going to be at this 98 level. So volume is really contracting If you look at the last couple of years for some context, we'll go back 5 years. This is going to be the high point of, we've had a couple pretty significant highs for a 52-week period, but you can see over here, this 52-week period, we had a really low 52-week high for volume, and that sparked a jump in volatility, and we could have, this is going to be our new low for a while. I don't think it will spark an immediate jump in volatility, but you can kind of see what happens. So initially we had that high point here in October, so it took about another year before. So something very similar. Could we go for another year from August into next August before we start to get a jump in volatility? Of course, if there's any uncertainty around the presidential election, there would be your fundamental cause for a jump in volatility. I doubt that that's going to be necessarily the case. Let's take a look at the VIX here really quickly. As always, we jump up early in volatility, and volatility drops throughout the day. That's a big factor for us in the options inventory trading class, as we made some new trades today that I put out there on our real-time trade alert service. But you can also see today's volatility drop finished below Friday's. So we're back down. We did jump into the neutral zone here, but we filled in the gap, and we're continuing lower. And so look for volatility to continue to, this is a little jump in volatility, and this is a little near-term volatility we're getting, and we get back below 12 or get towards 12, that could very well keep us on this intermediate grind for a while into that third and a half month. A jump up above here. Your intermediate pullback is going to more likely get volatility up here. So you can see it's starting to build a little bit. It's higher than what it was. We were grinding, especially in November. We had some volatility compression. December we had a jump in volatility, and so far in January we have a pretty decent range in volatility. When you look at the monthly range, it's not too big, but about 4 points, and of course a move back up towards 20 would give us about an average. That would be an average range, and more likely would give us that intermediate low point that we can bounce off of. If it occurs this month, more likely towards the end of the month when that happens. Okay, before we look at some other things here, we'll take a quick pause and see what you think about that technical outlook that we just came up with. Do you agree with that assessment? Do you disagree? There's a link right there popping out on the top right corner of your screen. Click on that link. It opens up a poll. Then hit either agree or disagree. If you click disagree, comment down below as to why. What are you seeing that you'd like to share with the rest of our community here that tells you that either you're a lot more bullish than I am, or that you're a lot more bearish than I am right now? Again, everybody's got an opinion, but what's driving your opinion? And I've noticed some of you comment with some technical outlooks, some other technical signs that you're seeing, indicators that you're seeing too. So share that with us down below. All right, now let's take a look at what's driving the price action today. And we'll take a look at the asset class comparison chart. You can see how bullish risk appetite has been, so it's not surprising. In fact, if you look at like the rate of change here for things like the S&P 500, for an example, pull that up here. And then you see, that's a pretty strong move. That's a pretty high 3-month rate of change. You look at the Russell 2000, it's also pretty high. You look at crude oil, especially, it's also pretty high. You look at emerging markets, which just really haven't been doing too well, but it's got a pretty high 3-month rate of change. So, you look at these signs and you say, okay, it doesn't mean that we have to go down, but it's a pretty good sign that we'll probably slow down here for a while in terms of risk appetite before we get a much smaller rate of change over a 3-month period that sets us up for a better bounce higher. For example, when we got this leg higher, you can see where the 3-month rate of change had dropped to. Of course, that leg higher, we were negative in the 3-month return. So I don't think we'll get negative, but I think we'll get down to a lower number that can set us up for a new leg to the upside in terms of risk appetite. Going back to just today, the asset class comparison chart just for today. So we'll do a custom chart and go to today. We'll look at a 10-minute chart here. Give it a second to load up. So you can see gold. Not so geopolitical news is a positive for gold, and you can see what also helped gold today is a drop in the dollar. But again, in terms of like safety trades, long-term bonds were really down. We're down today the most. Now these are smaller moves, and this is a little bit of an outlier. But keep that in mind. Emerging markets are down, so these are kind of two asset classes you don't consider next to each other more often than not. Not surprising that crude oil came down. It was started higher with the tensions, but fell by the end of the day, which kind of shows you what the market thinks about those tensions. Small cap stocks underperformed large caps. They finished the day at the high of the day, and so did developed markets. So even though emerging markets were down and small caps lagged, you still had some positive returns in equities. So there's some risk off, but very little bit of risk off, and especially with emerging markets and oil. But there's some risk and also risk off too with long-term bonds, and gold being up simply again because of the pattern, or at least the geopolitical tensions here. If you look at the chart for gold, I mean, look at that move. I mean, you had a cluster here on Friday. Here's today's move, and look at that big long upper shadow coming off of the cluster. Now the cluster's at the beginning of the intermediate run, so this is a little different than that cluster. If you take a look, if I were to go back, say, a couple of years, this intermediate run, we had a pretty good run, a cluster kind of in the middle, or before the run was still pretty mature, but then you got a cluster at the end when you had a mature run, including the market sentiment line there. And that's what prompted some, more of a multi-month decline. This is a different story. We have a cluster here at the beginning of an intermediate run with the market sentiment line still pretty low. So with that being the case, now that's a long upper shadow. In the short term, that's a little bit of a bearish signal. And if things do simmer down this week, you look for gold to pull back, because I think a lot of this 2-day, this move here is on that news. And you have a tremendous near-term divergence set up here. So, we could pull back down towards, 1500, 1515 in this area. If you take a look at the Bollinger Bands for gold to see where the volume levels are, right around that 1515, it's a big volume node there. So we could definitely pull back into that area here in the short term. But I wouldn't expect a long term. I think that's a good cluster at the beginning of a move that can set us up for another decent run. Because again, the idea on the dollar is that it's making a run. I don't expect the dollar to have a good move here this year. We've bounced, we've pulled back. I mentioned not to put a lot of stock into that bullish engulfing pattern, and it didn't play out very much. We're rolling back down here. We're on a strong bearish trend. We're just barely getting a death cross. In fact, this is the first week of the death cross. We got bearish trends on the Hakunashi candle. If you look at the trend strength indicator for the dollar, you can see that we're starting to build into a bearish trend. Right? We've been pretty noisy until now, but the trend quality is above 1. So we got a weak bearish trend developing out of this on the daily chart, and of course on the weekly chart. We're still noisy, so you still got some long-term potential for bearishness to come out of this. We've been noisy this whole 2018, noisy to the upside, but noisy this whole 2018 with no real strong trends developing. After a good bullish trend in 2018, I wouldn't be surprised, and it looks like we're starting to develop into where we'll probably get a move like this, but to the downside in 2020, which actually would be a very, very good thing. Not just for gold, but also for equities in general, especially those international equities, especially emerging markets. They would benefit the most from an equity standpoint from a weakening dollar. You can see the market starting to price that in, right? Because they've had a really good run. And this, again, on a weekly chart, you can see you have a moderately strong bullish trend developing. And there's what happens here. Let's put on a comparison with the dollar index in here. There we go. We'll put on the dollar index here. Hit OK and hit OK. So here's the dollar dropping, and look at the strong trend you had in emerging markets as a result. So, and as the dollar rallied throughout 2018, then we had a bearish move in emerging markets. And then as we've been noisy in 2020, then it's been pretty noisy in emerging markets too. So it looks like the emerging markets are starting to price in some building weakness in the US dollar and anticipating a really good 2020. And like I said, that's not just good for gold. It's not just good for emerging markets. It's good for risk appetite in general when the dollar pulls back like it is. if I go back to kind of a long-term chart where that death cross is setting up, and we got that later in 2017. But if I were to go kind of zoom out long-term on this, and here let me see if this will let me move this up here really quick. So I'm going to fit the studies and see it. There we go. You can see we're relatively high on the dollar. Relatively. Like for all of the 2000s or late 2000s, early teens, the dollar's been a lot lower than where it's at right now. And so, we're pretty high, especially compared to other currencies. So that sets us up for that we could have a pretty decent move to the downside. And again, that would be very good. Very, very good for risk appetite in general. All right, now let's take a look at the sector moves here today, and we'll go to the comparison chart first. So you can see that the FANG type stocks, the XLC communication services did really well. Energy stocks bounced up, even though initially energy started strong, or crude oil started strong and finished low. Energy started strong and finished stronger. So good move higher in a very, very beaten up sector. Healthcare outperforming, the other sector outperformed. Interest rate sensitive sector like utilities ran up here, even though stocks were rising. Utilities and staples and real estate were rising too, along with healthcare. So little risk aversion move, but then they came off of its highs. You can see materials finished down with the lowest, and industrials and financials, which have been very strong. You go back to the 3-month chart here, and you look at that 3-month rate of change, which is essentially what this chart's showing for all the different sectors. And you can see they've been doing well. Financials, industrials has been pulling back a little bit more with the market, but still kind of matching there. There's financials, healthcare, technology running up, and of course utilities and real estate, which had been so strong, and staples to a degree. They're giving back some of those gains over the past few months. Just some of those gains though. So that's, again, this unwinding of the safety trade, which is what I thought would start the long-term move, we've been undergoing that unwind, but not nearly to a significant degree. And when you take a look, again, that financials as bullish as they are, when you look at the 12 grid for this, and again, when you have pullbacks or weakness, and after you've had a good move, then the leaders tend to just slow down, right? Well, it's either you catch up or we pull back. And you see, there's your utilities and real estate and energy bouncing up over the past week, and materials really dropping. But look for that. I mean, that's a pretty good bullish pattern here when you get light pink shading in the yellow line. So watch for a bounce off of that you're already seeing in places like healthcare, and staples got that bearish pattern, or bouncing up here, or bouncing off of lows, and all these other areas too. So these didn't show the same pattern. So there's more upside potential for things like energy and materials, staples and healthcare, whereas any upside gains might be limited in some of these more cyclical areas because they're still very strong. They haven't pulled back very much yet at all, which again shows that don't add a lot of risk to the upside here. You can still ride the trend and make bullish trades. Just keep your risks smaller, so that if and when we ever do get just an exhale, not even like a drop off the cliff like a market sentiment pullback, but just an exhale, even if it's just a weak intermediate pullback where the intermediate line drops below 80 but not even below 50, it doesn't kill your P&L and your portfolio balance because you're loading up and we were so bullish. We got to load up when we're coming off of these lows. These types of patterns here. These are the areas where you can add risk, not when you're showing clusters and you've been bullish for a few months. With that said, the financial sector has been one that's been very bullish and very well could start to show some, in fact, has been showing weakness. Here's Wells Fargo, which you see how bullish it's been when we started coming off of those August lows, and then here's the move off the October lows that the rest of the market did. But now we're pretty high, 52-week highs. We're starting to pull back here. In fact, if you look at the Bollinger Bands for Wells Fargo, you can see that we're flirting with breaking into this gap, and that's a pretty significant. We moved up so far so fast with very little volume and built up a lot of volume here that's now above us. And the path of least resistance now is to the downside. Excuse me. So which sets up there's some strong support down here. So again, that can still be a pretty decent move to the downside. You notice the nice good strong trend that we've had on Wells Fargo. And move down there would get us towards the lower end, get us down below the cloud, and we're already down below the blue line, and the green line's about to cross below the blue line. And the strong bullish trend that we've had has gotten really flat. And when you look at it on a weekly basis, you can see how we've been on. We never did get to a strong trend where we could stay bullish for a while, and now we're breaking below the green line, and we've got some room to fall to the cloud there too, with the blue line very, very low. So again, opportunity, especially with the DMI showing that breakout pattern of being above the negative index being above 25, the positive index being below 20. Sorry, we're a little slow today on the interwebs here. There we go. So if I were to pull up Wells Fargo, you can see that that the beginnings of what can be a trending move to the downside. It always starts off like that. Now, not all these patterns lead to a trending move, but every trending move starts off like this. And then you add that with all these other indicators that we're seeing, including the fact that we're breaking below the 50-day moving average, which is well above the 200-day. You can see there, filling in that gap towards the 200-day moving average is what you could definitely see on any kind of, like I said, intermediate pullback on what has been a very strong sector. So we take a look at its options chain. And what we did today is we sold that $50. We bought the 52.5 put, which is your at the money put, and we sold to help cover some of the costs. We sold the $50 put. So we limited our downside returns because we don't expect a big downside move. But we expect enough of a move that we can get a pretty decent reward here, so you can see it's already filled in, a pretty decent reward for the risk that we're putting on. And again, earnings is coming up, the market's bullish, so I don't want to put a lot at risk. This is actually half of what normally we put on in our classes, in our class trades. So worst case scenario is we'll lose half of what's of normal, and then we typically try to cut that in half too. So at most we're going to risk $280 to try to make almost $1,200. So a very, very small risk compared to what we normally do, and a pretty decent return for that risk if Wells Fargo fills in those gaps that I mentioned to you on these different charts, with a little bit of the breakout signals that we're already seeing. And you can see the Hakinyashi showing after multiple transition candles, a bearish trending candle here. So that wraps us up for today. Again, as always, thank you very, very much for watching. You've heard from me now. Now we want to hear from you. Use that link right there popping out in the top right corner of your screen. Open up any new thread, and let's keep this conversation going about what we talked about in the video today, or anything we didn't cover that you want to get a conversation going on that relates to what we've been talking about. Again, thank you for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on our video down below. Follow me on Twitter for more content in between these videos, and join our community at marketscholars.com, as well as our community that we've created, our Facebook group that we've created. Again, thank you. Have a great rest of your Monday evening, everybody, and we'll see you all tomorrow.